So the class is understanding the HECM or reverse mortgage for home purchase. It's a 2-hour continuing education. We will have a 10-minute break at the top of the hour, so feel free to hang out until then, and then you can go get a cup of coffee or take a break for a moment. The way I like to do my presentations is very interactive. So feel free to ask me questions. You can turn on your mic and ask me a question verbally. You can type it in the chat, whatever's best for you. But it would be very helpful if we got into a conversation and discussion. I've been doing this for 26 years. I like hardball questions. I like the negativity. I like, even if you think that it's positive, but you just want to ask a negative question, just ask me anything. You cannot trip me up because my heart loves the home equity conversion mortgage. It is the most amazing mortgage on the planet. It's the safest loan in America, and I want to discuss why that is. It is absolutely a fantastic program that's backed by the federal government. At least what we're talking about mostly today is the FHA, HECM, Home Equity Conversion Mortgage, aka reverse mortgage. And Don is going to monitor the chat. So if there's anything that comes up in chat, Don's going to interrupt me and ask the question. So what the heck is a HECM? There's my first joke of the day, and they only get worse from there. All right, here we go. All right, so let's go back to 1961. And the reason I want to go back that far is it might give us an aha moment on why people think that if we do a HECM or reverse mortgage, that you're going to lose your house. Because that's how it worked 7 decades ago. So the story goes, little Nellie Young, a widow, whose husband, who was very popular in this small town in Maine, had passed away and left her a widow with one income, possibly no pension, but regardless, she could not sustain her life with what was left. And back then, savings and loans were very popular, so she went down to her local bank, talked to the banker, and said, I need some money. And the bank said, you don't have credit, you don't have a job, you're a woman, all the reasons that they give back in 1961 and why they were not going to give her a loan. But they worked out a deal with her. I tell you what if we gave you some money in exchange for the deed to your property? We'll let you stay in this home the rest of your life, but when you die, the bank will own the house. And poof, the very first reverse mortgage was born. Now, was that a bad deal? I personally don't think so. Now, was it a bad deal for her kids? Yeah, you could probably say that. But the most important person on the planet is our client, right? It's not our kids, it's us, it's me. And she needed financial help to be able to stay in her home for the rest of her life. Upon her death, there's nothing going with her, right? There's no money, there's no checkbooks, there's no house, there's no horse, there's no Cadillac, there's nothing going with her. So the most important thing is for her to sustain life. Well, it's an interesting concept that had been never had been done in the U.S. ever before. And interesting enough, the UCLA professor got a hold of this story because it hit the news. And he thought this was interesting. Some kind of a housing annuity. And by the way, for those who don't know what annuity is like a fancy word for a savings account. Banks offer certificates of deposits, insurance companies offer annuities. But at the end of the day, they're basically a savings account, just to keep it simple. So what if we turn some homes into some kind of a housing annuity where people could actually live off of the equity of their home? The problem is when you get a loan, it's usually a mortgage payment is attached to it. Well, what if there was something sort of like Nellie Young where you could extract some money from your home and not have to pay it back until sometime in the future? Well, poof, in the 80s, the Federal Housing Administration, under a proposal by Senator John Hines, came out with this idea, and they called it the American Homestead Act. It was the foundation for some kind of a government-insured reverse mortgage. They called it the Century Plan. Now, this is 40-something years ago. Does it really matter? Well, maybe, maybe not. But this was the beginning of the safe type of the bank's going to take you home. Now, they called it a HECM, a home equity, right? We know what that is. Conversion mortgage, because that's what it is. It's a mortgage. Home equity conversion mortgage, a HECM. But they've been calling it a reverse for so long that the word reverse mortgage sort of stuck. Now, in hindsight, I wish it didn't because people don't like reverse mortgages. And the reason, other than the story I just told, is maybe because we have been programmed to know that when we get a mortgage on our house, we buy a house, that we're going to borrow money from a bank. The bank's going to put a lien on the house, right? That's a mortgage. The bank's going to has a financial interest in the house. The bank's going to put a lien on the house, and we're going to make payments every month for 30 years. And eventually, we're going to have the house free and clear, right? That's a mortgage. The bank is in the lending business, not the real estate business. They don't want your car. They don't want your house. They don't want your credit cards. They want their money back. So a mortgage, in the simplest of terms, is nothing more than a bank lending you money to buy a house, and they put a lien against it to protect their interest. And here's the sort of a trick question of the day. I'm a veteran, and if I go out and buy a house today, and I put nothing down, all right, I get 100% financing, a VA loan. So I buy a $300,000 house, I put nothing down, I borrow $300,000 from the bank under a VA loan, and I have a closing today. Don't answer this question, but I'm going to ask the question as if it's a question. Who owns the house, me or the bank, on the day after we close? You don't answer that. And the answer is me. I have no equity in the house, but I have title to it. And when the taxes come due, I've got to pay the taxes. Homeowners insurance, the maintenance of the house. If I were to sell the house tomorrow for $350,000, then I made $50,000 profit, not the bank. If I sold the house tomorrow for less than I paid for it, then I owe the bank the difference, right? The bank does not own the house. The bank has a lien against it, but you have the title to the property. So, interesting enough, even real estate agents who are in the business get that question wrong. Who owns the house? A mortgage is just a lien against the house by the lending institution. So many people say, well, yeah, but if you do one of these reverse mortgages, the bank owns the house. You've lost your rights. That's completely false. Well, but you don't have any options. Eventually, the bank's going to own the house. No, this is just a mortgage. It's a reverse mortgage, a HECM. We're going to teach you to get the word reverse out of your language in just a moment. But it's just the definition of a no payment mortgage. Okay, a forward mortgage, as I call it, a forward mortgage is where you forward a check to the bank every month for 30 years, and a reverse mortgage is where you don't forward a check to the bank. Remember, it's still a mortgage. It's still a mortgage. It still acts like a mortgage. The bank puts a lien against the house. There's an interest rate attached to it. It's money borrowed. A mortgage is a mortgage is a mortgage. Call it an FHA loan, a conventional mortgage, a VA loan. Call it what you want to call it. But at the end of the day, a mortgage is a mortgage is a mortgage. So in 1988, Ronald Reagan signed this thing into law. And the HECM, the FHA HECM reverse mortgage, the very first one actually closed in 1989. So it's been around for 37 years. It's been around for a long time. The first 15 years or so, it didn't get much traction. The last 20 plus, 25, it's been doing quite well. It's not as mainstream as I would like it to be, especially since it's been around since 1989, but it's available for retirees, and I believe that everyone should understand how this program works. It's not right for everybody, but I think everyone should understand that this is a financial planning option. And then to fast forward to what we're talking about today in particular is the FHA HECM for home purchase. This is where real estate agents get involved. This program launched during the housing recession and officially launched in 2010. It was signed into law in 2008. They didn't have the bugs worked out. They sort of launched it in 2009. They still didn't have the bugs worked out. And finally, by 2010, we had the very first HECM for home purchase loan closing. So that's 16 years ago. It's been around for a while. According to NAR, most realtors have never heard about this program. They may have heard about the refinance, but only 3% of the, I don't know, million realtors in the US know that you can purchase a home with a HECM, a reverse mortgage. Any questions yet? All right. So this class is mostly about the FHA HECM for home purchase. We're going to be talking about the refinance from time to time, and we're going to be talking about the portfolio or proprietary, or call it a jumbo HECM if you want. We're going to be talking about that as well because it fits in nicely, and it's pretty much the same program, just not FHA guaranteed. So let's get started. So first of all, reverse mortgage, and it's just a generic word for the HECM. And it's sort of like a dog. All right, we all know what a dog is, or do we? A dog could be a greyhound, it could be a German shepherd, it could be a Rottweiler, it could be a poodle, right? A dog is a generic term for an animal that we've domesticated. If you were in the dog breeding business and you wanted to sell lap dogs like a Shih Tzu, you would advertise Shih Tzus for sale. If you're in the guard dog business, you would advertise German Shepherds for sale, right? You wouldn't advertise dogs for sale because somebody would show up to buy a Shih Tzu and all you have is Great Danes or Rottweilers for sale, Pit Bulls for sale. So you would advertise what you're selling. And I want you, as a professional realtor, to do the same thing with this. Reverse mortgage is a general term that people don't like. They don't like reverse mortgages. You ask them why, and they don't really know. Well, my neighbor's first cousin's brother's uncle, they did one of these and they lost their house. Well, how did they lose their house? I don't know, but it was bad. What do you mean you don't know? Well, I don't know. I just know it was bad. They should have never done it. But you don't know why it was bad. Well, you could say the same thing about people who lost their home in 2009, 2010 during the housing recession. There was people that had stated income loans that lied on their application, said they made $1 million a year in income, and they bought a house they couldn't afford, only to have it go in foreclosure in 2010. They lost their home. You could say, well, buying a house is bad. Well, why is that? Well, my neighbor's brother's first cousin's uncle, they lost their house when they did a mortgage. Well, how did they do that? I don't know. I just know the economy was bad, but it was bad. So they lost their house because of the economy. Well, I don't know. It doesn't make mortgages bad. It doesn't make home ownership bad. The situation was bad. So we're going to get into the good, the bad, and the ugly of HECMs. But the first thing I want all of us to do is call this product what it's legally named, which is home equity conversion mortgage, a HECM. And for those of you who don't quite get the dog analogy, let's talk about the fruit analogy. Plant City is known for strawberries, and they have fruit stands all over Plant City. But they don't call them fruit stands, they call them strawberry stands. So a lemon is sour, a grape is sweet. Let's call a grape a grape. Let's call a lemon a lemon. If you're selling strawberries, let's call it a strawberry stand. All right. So we talked about the HECM for home purchase that was launched in 2008. FHA released a 2009 mortgagee letter. If you look down towards the bottom, it says in 2009, HUD released ML, mortgagee letter, 09-11. That means 2009, and it was the 11th letter of the year. Don't write that down, don't remember it, but those are important terminology in our industry. If somebody needed to research some history, you would find these mortgagee letters. If you look at the very last line, it said that letter superseded ML 08-33. So mortgagee letter in 2008, the 33rd letter of the year. If you want to look those up, you can go to hub.gov. So to beat a dead horse one more time about dogs and fruit, the Federal Trade Commission only recognizes 3 types of reverse mortgages. And this is where it sort of hits home that a reverse mortgage is generic. Because the definition of a reverse mortgage is a type of loan that has no required optional monthly mortgage payments. It's not necessarily the FHA HECM or a proprietary HECM. It could be a tax deferral program. Every county in the state of Florida, and probably across the nation, but definitely in the state of Florida, If your clients are of limited income and they own a house and they are not able to pay their property taxes, they can apply for a property tax deferral. Now, it's not a waiver. It doesn't eliminate the property taxes, but allows them to delay paying those property taxes for perhaps the rest of their life. And if saving $1,000 or $2,000 a year in property tax payments is going to help them stay in their home, the county is there for them. And that way, by not paying the taxes, the tax deed doesn't get sold and they could potentially lose their house for the value of property taxes. So it's a property tax deferral program for those that are 62, I believe, in most counties, maybe 65. Every county's got their own rules, but they're all basically the same. They have to be of a certain age and they have to have a certain income means for the whole household. So if you have your grandkid living with you, they look at the entire household to determine if they're going to waive the property taxes. That is a reverse mortgage. That's my point. When someone says reverse mortgages are bad, well, are they talking about the property tax deferral program? Are they talking about the jumbo HECM? They're talking about the FHA HECM? What are they talking about? You can't say reverse mortgages are bad unless you specifically talk about the type that's bad. The CFPB recognizes the three types, and the Federal Trade Commission recognizes the three types of reverse mortgages. All right, any questions yet? Okay, so one more time. The HECM is a type of reverse mortgage, not the only reverse mortgage. The FHA HECM happens to be the best and safest kind. I'm not saying that the portfolio loans are anywhere unsafe. It's just when you have the federal government backing up something, you can't get anything more safe than that. Because if the federal government goes out of business, well, we're all in trouble. Right? If a company goes out of business, well, the company's out of business. Sorry about that. But the federal government goes out of business, we're all in trouble. So this particular program that we're going to be mostly talking about today is sponsored by FHA. It's insured by HUD. And the FHA HECM has a fantastic reputation and satisfaction rate going back nearly 40 years. In fact, AARP did a study about a dozen years ago and determined that of all the people who have ever closed an FHA HECM, 96% of them were completely satisfied with their program. Now think about that. Google is 5 stars, right? Yahoo reviews and whatever else is out there. 5 stars is the best. This is 4.9666666, right? This is nearly perfect score. There's been well over 1 million HECMs closed over the last 35 plus years. Over 1 million people in the U.S. have closed HECMs. And when AARP did their study a dozen or so years ago, most of the people said, yeah, this is an amazing program. So when you hear bad stuff on the street, the first thing that should hit your mind is, well, they don't know what they're talking about. You know, and you can ask them, well, what have you heard? Well, I've heard my first cousin's friend's neighbor's uncle said that they lost their house or they wish they'd never done it. Well, tell me more. They can't. So pin someone down and get them to say what happened, because chances are it had nothing to do with the mortgage. I've met people that, well, they didn't pay their property taxes, but you know, the FHA or the HECM is what caused the problem. Wait. How did a mortgage cause the problem of, how did a no payment mortgage cause a problem of someone not paying their property taxes? Right? They have nothing to do with each other than if you don't pay your property taxes, you're going to lose your house and your mortgage. So the HECM for home purchase has no required monthly mortgage payments. How would you, right? How would you, Melanie? How would you, Pamela? How would you, Stacy, and whoever else is on the? I only have so many people on my list here. How would you like to get a letter in the mail today from your mortgage company that says, you know, if you want to skip this month's payment, you can. No, you still owe it, but you can just pay us later. You know, when you go to sell the house in 30 or 40 years, how would you like to skip payments the rest of your life? You still owe the money. You still owe the interest that's accumulating, but how would you like to skip a mortgage payment? I think a lot of people would say, yeah, I'm interested. It's Christmas time in July. It's Christmas time. Sure. Yeah, I'll skip a payment. Again, they're not waiving it. They're just letting you skip it. So this is an optional monthly mortgage payment for the rest of the retiree's life. And that's pretty cool. If you think about about that, it's really cool. Now, one of the negativities about these HECMs is that because there's no payments, then eventually you're going to owe a lot of money. Well, the industry, our industry, HECM industry, doesn't use the word no required or optional. That's something that someone told me about 15 years ago that I should include that in that sentence, and I have been, because that eliminates the objection. When someone says that if you do one of these loans, you don't make payments, well, eventually you're going to owe more than the house is worth. And my answer to that is, well, if you choose not to make a monthly mortgage payment, then yes, it's a rising debt loan. Now we're gonna talk about, are you ever going to exceed the value of your house by not making mortgages? We're going to talk about that a little bit later. The answer is no, by the way, but it could happen. It just depends on the economy. But one more time, the reason we added optional monthly mortgage payments, or we added no required, is because the word no means no. It just means no. So it's a bad word. No means no. So no required monthly mortgage payments softens that up and makes it an accurate statement. So whether it's a HECM for home purchase, whether it's portfolio HECM for home purchase, FHA HECM for home purchase, or refinance HECM, refinance reverse, it's still a no payment, no required monthly mortgage payment program. Now, when it comes to a purchase, the down payment, depending on a person's age, is about 65%. I've had customers tell me, well, I've got 20% down. Well, this is not the program for you. Let's talk about a conventional mortgage. This is for cash buyers. Most real estate agents, when they deal with senior citizens, the seniors have a lot of money. They may not have enough money to pay cash for the whole place, but they usually have a substantial down payment. And the down payment is based on a couple of factors. The number one factor is the person's age. So a 62-year-old is the youngest age a primary borrower has to be in order to qualify for the FHA HECM. The portfolio HECMs go down to age 55. For the FHA HECM, the spouse can be of any age as long as one of the spouses is 62 and above. And there's optional monthly mortgage payments for the rest of their life. Not for 30 years, but for the rest of their life. If they're 62 and they live another 50 years, they're 112 years old, it's no required payments for the rest of their life. No required mortgage payments for the rest of their life. They still got to pay homeowners association, homeowners insurance, and property taxes, and maintain the house. They got to maintain the house. Well, it's their asset. They want to maintain the house. All right. Any questions?
Yes, Linda's asking about, just to make sure, regarding the payments, you can still make a payment towards the balance.
You know, the quick answer is yes, but you started it, so I'm going to answer it the long way. All right. I need everyone sitting down for this answer. And Don's going to love me answering this because he always complains that I don't get into this, and I'm going to get into it today. I'm going to satisfy Don. This program is too good to be true. All right, everyone's sitting down, right? This program is too good to be true. So most of the FHA, like 96, 98% of all the FHA HECMs that are done are adjustable rates. And some people say, whoa, we want a fixed rate. Well, when you understand the program, no, you want the adjustable rate. It's based on the Treasury bill. The Treasury bill is a very conservative index. It's relatively low. Right now, the interest rates are running at about 6.5, 6.25, 6.5%, which is a little bit less than regular mortgages. They're closer to 7 right now. So the interest rate's very reasonable. Payments are optional. But here's what FHA did. They started it way back in 1987 when it was passed into law and signed into law in 1988. And then they reaffirmed it in 2009, 2010 when they came out with a HECM for home purchase. All right, here we go. Anytime a payment is made on this program, of course, it pays down the principal, right? Of course, it pays down the loan balance. But every penny that is paid towards the mortgage is added to a line of credit. No different than a home equity line of credit, a HELOC from your local bank. It is added to the savings account. We call it a line of credit. It's added to the savings account portion of this loan. So it pays down the mortgage balance and is added to the line of credit. The line of credit can be borrowed, can be re-borrowed at any time at no charge. So imagine this. We close a loan and you're a customer. You sold a house and they put a substantial down payment, 65%. They finance the difference into no payments. But your client is concerned about the rising debt loan. Remember, there's interest attached to this, but no payments are required, which means the balance goes up every month, right? Because you're not making a payment. So let's just say that when they get their very first monthly statement, your client looks at that and says, it's $1,000 of interest that's been added to my loan balance. $1,000. I don't like it. I don't like it. I'm going to make that payment. I'm going to write a check for $1,000 and I'm going to send it in. That way my loan balance is always the same. And they do that every month for a whole year. They put in $12,000 from their checking account that they could have used for retirement. Instead, they send in $12,000 to the servicer so they can maintain their loan balance. And then something happens in 12 months. Heck, let's call it 2 years. They've got $24,000 in their line of credit. Something happens. The roof starts leaking. They don't have $24,000 to replace the roof. Their car breaks down. They don't have $10,000 to fix it. They don't have $35,000 to buy another one. Their kids call them and say, Mom, I want to buy a house, but I need some down payment money. Or another emergency came up, right? They want to take that cruise around the world that they've always been talking about. They wish they had not made that mortgage payment. They call up the servicer and they'll send the entire $24,000 back at no charge. Completely refundable. Remember, it's borrowed money. If they take it back now, they owe it. But there's no charge to get that money back, as if they never made the payments in the first place. So people use the line of credit like a savings account. It's there for a rainy day. It's there for emergencies. It pays down the balance, which saves the 6.5% interest that's been accumulating. It adds to a reserve fund that they can take in the future. And it doesn't matter if they did the HECM for home purchase or the HECM refinance. The line of credit works the same way. Any questions on that? It's the most amazing program on the planet. All right, so someone says, so you're saying even though you have a HECM, you can make a small, okay, that's probably a previous question. Okay. Yes, any amount at any time, Donald says. Thank you, Don. If it's an adjustable rate, is there a cap? When I bought my first house, it was 18%. Yeah, we all remember those days. And that would be a lot of interest accrued. Yes, accrued. Yes. The good news is there's a 5-point cap on the interest rate. So if it starts at 6.5%, it can go as high as 11.5%. So yes, could that happen? Yes, absolutely. Absolutely could. The good news is that has not happened since the interest rates calmed down in I guess, the mid 80s. I don't even remember when the interest rates went back down to something that was more reasonable than 18%. So yes, it could happen again. The good news is that there's no required payments. Yes, the interest would accumulate much faster at 11.5% than it does at 6.5%. But remember, a person does have the option to make a payment if they're concerned about that, or they may say to themselves, "Man, thank goodness I don't have a mortgage payment because I wouldn't want to pay 11.5% on my loan balance." All right, Don, if there's any other questions, just read them out to me. Okay, so all HECM for home purchases have no required monthly mortgage payments. They all do. Whether it's portfolio, an FHA HECM, they're all no required payments. The down payment, I like to say 65%. A 62-year-old would have a larger down payment than an 82-year-old. Why? Because a 62-year-old has 30 more years of life, where an 82-year-old may have 10 more years of life. So FHA or the portfolio banks take that in consideration. So a down payment for a 62-year-old might be 70%, where an 82-year-old it might be 60% or even 55% because they're older. Now, it might be a little bit complicated for those that are math challenged, because not all of us can do math in our heads, to rather than try to figure out what 65% down is on a $469,900 house, right? How do you do that? Pull out your calculator and figure out 65% of some odd number. Do it in reverse of reverse. Ask your client, how much money could you put down comfortably if we were to go out today and find the perfect home today? I'm talking about the one with a swimming pool that has the golf course view, that's not too far from the beach, whatever their dreams are. The super nice kitchen with 2.5 bedrooms and 5.5 baths. I'm making a joke here. You don't have to laugh. It's all good. I'm in comedy school, by the way. I got an F minus. Anyway, so they said, well, if I found the perfect home, I could come up with 300,000. You can do the math in your head with that. Half of 300,000 is 150, right? 150 plus 300, now we're talking third grade education, is 450. You can say, without knowing too much more, what their ages are, but you have to know they're at least 62 or 55 if they're doing the portfolio. 50% boost in purchasing power on a $400,000 cash down payment gets them a $600,000 home. Right? 50% of 400,000 is plus 400,000 is 600 grand. Now, we're on commission here. I'm a loan officer by trade. So I make my money. I'm the president of the HECM Association, but I make my money selling loans. So the higher the loan, the more money I make. The higher the home value is, the more money you make. Fair enough? Would you rather sell a $600,000 home or a $400,000 home? Right? Well, that's what you just did. You're helping somebody who has a lot of money, 400,000, buy the home that they really want, not the one they have to settle for, a home that they really want with no required monthly mortgage payments, and you're getting paid extra for that. You've got a happier customer who socialize with senior citizens, because we all socialize with people close to our age, and you've helped them buy the house that they really wanted. Or if they came to you and said, I have 250,000, I'm going to keep it simple. I have $200,000 cash. Sell me a home. Now, this is a good question. I want you to answer this at least in your head. If someone came to you today with $200,000 cash money and they said, sell me a home, what's the first thing that hits your mind? They don't want a mortgage. They want to pay cash. What's the first thing that hits your mind? You're not selling a home to them today because you can't find a home in Florida for $200,000. You can't. Maybe you could, manufactured home, maybe a dilapidated home, but it's not the home that they want. But then you remember that you spent 2 hours on this course and there's this HECM for home purchase thing. 50% boost in purchasing power on a $200,000 home gets them up to a $300,000 home. Now the same question. Could you sell them a home for $300,000? Yeah, probably can. It may not be the house they really want, but now they're buying a home that they don't have to make a mortgage payment on, that they can live in for the rest of their life, and they own it. And they own it, which means they can sell it when they want to. As the home goes up in value, they make more money. It's their home. If they want to have purple carpet and yellow walls, they can do that. If they want to rent out a bedroom, they can. Now, the next question that you may have is, well, how long does this take to close? The answer is just as long as any mortgage takes, about 4 weeks from start to finish. So the only thing that's quicker than doing this loan is a cash deal. This is a mortgage, so we have to go through title insurance and we have closing costs and we have underwriting and we have processing. But it takes 3 weeks on the quick side, 4 weeks on the realistic side, and if there's a snafu somewhere, then maybe we'll close in 5 weeks, but no different than a regular mortgage. All right, any questions? Okay, so I've brought this up briefly before, but I just want to hit home with this slide. The FHA program starts at age 62. So if one of the spouses is 62 or above and the other spouse is of any age, all the way down to age 18. As long as one of them is 62, they can do the loan, no matter what the spouse's age is, as long as they're an adult. That's the key. Now, we're going to base the down payment on the youngest person's age. So the down payment for somebody who is 18 years old married to a 62-year-old is going to be substantial, because this loan would be for the rest of the younger person's life. An 18-year-old could live another 70, 80 years, and there's no payments for life. So it'd be a very substantial down payment. Now, I've never met anybody that's 62 married to an 18-year-old. I did give a proposal. I didn't close the loan, but I did do a proposal for a 72-year-old married to a 25-year-old. Anybody want to hear the story? Because I want to tell it. I want to tell it. All right, so here's the story. So this guy, he lived in Tampa, and this was 15 years ago. This was a long time ago, but it's a great story. So this 72-year-old lived in a condo, and he wanted to do a HECM, and his primary goal was to pull out a little bit of cash, but he wanted to take care of his wife. And apparently he was down in the Dominican Republic a couple years earlier, and he met a 23-year-old and just fell in love. And she fell in love back. He brought her back to Tampa, and they got married. And she didn't speak any English, and he didn't speak any, I don't know what they speak in DR. Um, and they didn't speak each other's language other than the love language, the language of love. So he was trying to set her up. At the time, it was a $200,000 condo. He could pull out $50,000, and that would be nice to have some cash. And then she could stay in the condo for the rest of her life. She would pay the condo dues. She'd pay the homeowner's insurance. She'd pay the property taxes, but she could be there the rest of her life. And $50,000 just didn't do it for him. So we didn't close the loan. But it was a good exercise. It was the only time I've ever had somebody that was more than 30 years difference. I had an 80-year-old married to a 50-year-old once, but a 72-year-old married to a 25-year-old was different. All right, the portfolio is not an FHA program, but it has the same rules as the FHA HECM. It's done by banks instead of lenders, and it's not supported, not insured by the federal government. It doesn't make it any less safe. It's backed by investors. It's backed by Wall Street. It's backed by billions of dollars, and it's as safe as the FHA if you want to look at the details of the loan. Nothing is safer than the federal government, but they've been around for a couple of decades, and they've never done harm to anybody. So I'm comfortable with them. The good news on the portfolio, proprietary, whatever you want to call it, is that the underwriting's a little bit easier. The generosity of the loan is better. And the closing costs are lower. The disadvantage of them is the interest rate is higher, and there's no insurance fees, so therefore the closing costs are lower. But the ongoing insurance fee is built into the interest rate, so the interest rate's higher, and it's anywhere from the 8% range to the 9.5% range, so it's considerably higher. But it fits where it fits. It fits perfectly for condos. It fits perfectly for multi-million-dollar homes, and it fits perfectly for some people that don't qualify for FHA's very strict underwriting guidelines. And by the way, the underwriting guidelines are not that hard to qualify. In fact, let me give you an example. If any of you are even remotely in tune with the mortgage rules, regular mortgages, you'll know that the debt to income ratio has got to be around 42%, 41, 42%, meaning that if their income is 10 grand a month, their expenses needs to be in the $4,000 range or less per month, or they don't qualify for the loan. With this, they have to have $527 a month to be able to buy groceries, and they qualify. So we don't have a debt to income ratio per se. Most of these loans do not have a credit score requirement. The portfolio loans do. It's anywhere from 620 and up. But there's exceptions because the underwriting is easier than FHA. Where FHA, they'll write a loan for somebody with a 350 credit score, but they have to have enough money to be able to afford to live in the house that they're doing the HECM on. So each one has pros and cons of underwriting, and sometimes we start off with a HECM and we can't get it closed, so we switch over to a portfolio. And yes, the interest rate's higher, but something is better than nothing. And it's up to the customer to make that decision. All right, any questions? All right, 8 minutes, we're going to take a break. Okay, so the rhetorical, nope, I'm sorry, that's coming up next. All right, so when your client says, I want to pay cash for my home, what they're really saying is, I don't want a mortgage payment. Is that a fair statement? Because no one really wants to give up all their cash. They're willing to give up all their cash because they don't want a mortgage payment, not one in retirement. Because if you project out, I'm 62, I'm not, but if I was 62, give me 2 more years, I'll be 62. But if I'm 62 and I'm married and I want to think about the future, I have to realize that things are going to change, not necessarily for the better for the rest of my life. There's going to be some health issues. There's going to be some housing repair situations. I might want to remodel my bathroom, redo my kitchen. The air conditioner goes out, the refrigerator dies, the washer and dryer, they poop out. The roof, the scary roof, 15, 20, 30, $40,000 to replace the roof. Insurance companies want it replaced every 15 years now. And maybe they'll ease up on that requirement, but it's not pretty. And roofs are not cheap right now. Hopefully they'll come back down in value. But things are not going to get better. And if you're married and your spouse dies, then the income drops, the household income drops. So these are kind of things that people have to think about if they plan on having a financially okay retirement life. All right, here's a question, and I'm going to turn this into a joke because I like to. But here's a question. What is the number one fear? What is the number one fear that our clients, our senior citizen clients, are afraid of? What is number one fear? And some would say, well, dying. No, that's number two. Number one is running out of money. Number one is running out of money. And whoops. Oh, let me go back. That's what happens when you start hitting buttons. I'm trying to fix this so I can see everybody, but I don't know that I can. I got, there we go, found it. Okay. So there was a Seinfeld episode that turned this into a joke. You know, he asked what the number one fear was. And that joke was the number, what's the number one fear? And people say, well, public speaking. Public speaking is number one fear. And that's true. And Seinfeld turned that into a joke. And they said, that means somebody would rather be in the casket than giving the eulogy. Because number two is dying in this Seinfeld episode. Number two is dying. Number one is public speaking. But the number one fear of our clients is running out of money. And I know that to be true because all my customers are 62 and above. They're all retired or retiring. And they all fear. And as they get older, the fear grows more and more real. Because they didn't think they were going to live to 90 and they're still kicking it and they're still healthy at 90 and they're running out of money and they're scared of running out of money. Whoops. Okay. So the down payment is, I'm going to say this one more time, is based on mostly the person's age. The interest rate comes into a factor, and of course the purchase price comes into the factor. And they do the math. And depending on the person's age, it could be 60% down if they're older, could be 70% down if they're younger, could be 72%, could be 58%, but it's in that range. So I chose 65% as just a math, something in the middle. The good news is that when we do the math, whether you do the 50% boost in purchasing power or you do the 65%, that is inclusive of the closing cost. So we don't have to worry about additional math. If someone says, I've got $500,000 to buy a house, cash money, the answer is $750 is what you can go shopping for. If it's affordable, because remember, they got to pay taxes and insurance, upkeep, and so on. and that includes the closing costs. Now, in Florida, we have dock stamps, intangible tax, we have title policy, most likely a land survey. There's all sorts of stuff that goes into buying houses. And so those closing costs can be substantial, but it's already factored in to this example. This is a real house in the Villages. That's a real estate professional, Bob Reese. If you ever want to call Bob and ask him, I've known him for years, probably 15 years. And when he gets a listing, he asks us to create this flyer for him every time, and we'll do it at no charge. You just have to give us the address, give us whatever, give us a picture of the house, send us the MLS, whatever it is, and we'll create this flyer for you. And I'm a big fan of getting the conversation started. So create the flyer, leave it in the home. When other realtors show a house, they see this and it's like, well, this is interesting. How does this work? Right? Now you're there to sell the house. You don't know how this works. You don't really care how it works. All you know is that an 82-year-old can buy this $629,000 house for $349,000 down. For $349,000 down, somebody's buying this house, including the closing costs. How many $629,000 houses could you sell to 82-year-olds for $350,000 down? And the answer is all of them. This is to get the conversation started. So, the rhetorical question of the day. Now, I want you to think about this. We have 1 minute till break. Think about this. If you found out today and today only, that every house in the state of Florida was on sale, right? Like going to Target and everything in the store is on sale, 30% off, today and today only. Every house in the state of Florida is on sale for 35% off, 30% off, 40% off. Every home, no matter which home it is. Everything is discounted for cash buyers and for senior citizens. You have to be a senior and you have to have a lot of money for down payment. But you could buy the house for 35% less than the asking price. How many homes could you sell? The rhetorical question of the day, how many homes could you sell? And the answer is all of them. Now, we all know that's not totally true because you're going to finance the 30%. But the exercise is, if you sort of think that way, because that's what you're doing, you're selling a cash buyer a nicer house for less money and you're getting full commission. They own a nicer house, which will grow at a higher amount each year because of compounding of home equity. And homes increase every year. And you're selling them to them for less than fair market value. Well, with the difference being a loan. All right, with that, it is 10 minutes till the top of the hour. Let's take a 10-minute break. Who already has a regular mortgage. They own a house, they bought it who knows how many years ago. They have a mortgage now, they're making a monthly payment. Can we turn that into a no payment HECM? And the answer is yes. The numbers have to work. So let's use a $500,000 house as an example. A $500,000 house, let's say that their mortgage left is $150,000. That sounds like it's pretty low on a $500,000 house, but that's actually pretty common. Let's say that they're of the age where they could borrow $200,000. So we've done the math. They're 75 years old. We put in a $500,000 house in the FHA calculator. We put in they owe $150,000, and based on their age, based on the home's value, based on the current interest rate of somewhere around 6.5%, they qualify for $200,000. Right? Their credit score is 400. Doesn't matter. Everyone qualifies for the same amount of money based on age, home value, and interest rate. FHA does this calculation. If their income is $1,500 a month and their credit score is 450, everyone gets the same loan terms, the same loan amount. That's what's nice about these programs. So let's say that based on the numbers I just repeated or relayed, they can qualify for $200,000. They pay off their $150,000, they get the $50,000 in a line of credit or a lump sum, however they want the money. Monthly installments, they can get the money all sorts of different ways. The money that's available to them is tax-free. They don't have to pay income tax on it, so they can take a lump sum and not pay any taxes on it. And there's no required payments on it for the rest of their life. My suggestion to most people is pay off your debts, especially credit cards. Pay off your high interest debts and leave the rest for a rainy day. right? Leave the rest for the future. Number one fear is running out of money. So save the money the best you can. Get yourself debt free, save the money for a rainy day. If you leave it in the line of credit, it has not been borrowed yet, which means it's still equity in the house. So if you want to maximize your inheritance to your family, then only borrow what you need. Okay, so the answer is yes, you can refinance from a forward mortgage into a reverse mortgage. Can you sell a house up north and move to Florida using the proceeds of the other house? Absolutely. Where the cash comes from doesn't really matter as long as it's your cash. So you can't borrow. I mean, you can't borrow money to do a HECM, but you can certainly sell an asset such as another house, and that actually happens often. You can actually, if once you know the house somewhere else is up for or is going to be sold, you can go ahead and make an offer on a Florida home and do a contingency. When that house sells, I'll have the money to buy this house. The third question is a little bit more complicated. So if you have a pen and paper in front of you, feel free to follow along with the ink, but I'm going to make it as simple as I can. And I can do a lot of the math in my head, but I'm not going to make it complicated because then my head explodes. Okay. So the question is, if someone had a $600,000 house and they did a HECM, and let's say they only borrowed 25%, right? 25% of 600,000 is 150. So at closing, we give this person $150,000 in cash. They can use that money to pay off an existing lien. They'd have to. They can use that money to go to Vegas. They can do what they want to with it, but they took 150,000, and that's all they took. But they took it at the time of closing because we're going to keep this really simple. They're not making any payments, so the 150 next year is going to be higher than the 150, right? 6.5% is going to be added to that. So if you take, I'm going to use my calculator. If you take 150,000 and you multiply it by 6.5%, that's approximately $10,000 a year in interest, right? Just take my word for it because I use the calculator. So they're not paying $10,000 a year in interest on a $150,000 loan, which means that next year they owe 160,000, right? 160,000. Now I'm not going to do compounding of interest in my head, not going to do it. So we're just going to go 10 years into the future. 10 times 10 is 100,000. So the $150,000 that they borrowed 10 years ago is now the debt is now 250,000. Again, not counting compounding of interest. 250,000. The home, unless we're in another housing recession, the home is worth more. The home is going to appreciate, according to national statistics, at 4% a year. 4% on $600,000 is $24,000. So next year, this $600,000 house is worth $624,000. Fast forward 10 years, not counting the compounding of home equity increasing, the house is now worth $240,000 more than it was purchased for 10 years ago. So now the house is worth $840,000. Okay, everyone with me? I hope so. They owe $250,000 on an $840,000 home, and they passed away, or they decided to sell and move. The loan needs to be paid off. So the question that this person put in the chat was, how much money did they lose? Well, I'm gonna argue with that. They didn't lose anything. First of all, their home increased by almost 250,000. Future value of the home, money that's appeared out of nowhere, right? Because the house went up in value. They got 150,000 to spend how they want to spend it. They probably paid off some credit cards. They eliminated a mortgage payment, so they've saved the mortgage payment for the last 10 years. They had $150,000 to spend somewhere. Their house went up by $240,000. Their debt went up by only $100,000, and they still have a $600,000 house. To me, that's a win, win, and a win, and maybe even another win. They've had a better life with no additional outgoing expenses. They probably paid off some high interest credit cards. They're in a better financial position, and they have a house that's still worth $600,000 after paying off the lien. I think that when people slice and dice and when they do the amortization schedule and they look at the bigger picture, no mortgage payments for 10 years, and you do the math, I think people will quickly realize that this is a way to actually increase wealth. And one thing we haven't discussed yet, and I'm going to discuss it later, but I'm going to tell you now. What if you were to purchase a duplex, a triplex, with a HECM? You bought a quadplex with a HECM. You put your substantial down payment, you lived in one of the units, and you rented out the other three. Talk about cash flow, because the rent is yours. You live in one, you rent out the other units. All the cash flow is yours, and the property goes up in value, and that's also yours. There, cash is king in retirement. Let's talk about this slide. This is a non-recourse loan, and whether it's the FHA HECM or the portfolio HECM, they're both non-recourse loans. And what that means is if you take the word non and recourse and separate them, what does recourse mean? Recourse means to strike, right? It's a recourse. If you do that, there's going to be consequences. There's going to be a recourse. You're going to jail, whatever it is. So recourse means to strike. No recourse means not to strike. So the HECM is a non-recourse loan, meaning that if something bad happens, the lender were to fail, they don't honor the contract, the home goes down in value, you wind up owing more than the value of the property. If something bad happens, there's no recourse. Nothing bad can happen to your borrower. Furthermore, nothing bad can happen to the estate of the borrower, or to the family of the borrower, or to the credit report of the borrower or the heirs. There's no recourse. Whatever you throw at me right now, there's no recourse. The answer is no. There's no recourse. Worst case scenario is let's say someone did this loan in 2004. In 2009, homes went from here down to here, right? Because that's what happened in 2009, 2010. Homes dropped in value by 50%. What was 200,000 is now worth 100,000. People did a HECM in 2005, and they pulled out $100,000, $125,000, and their home went right down the toilet. And then they were done with the home, and they owed more than the house was worth. It happened a lot during the housing recession. And those who were done with the home, it's a lifetime loan, so they don't have to move just because the house is worth less. But when they were done with the loan and it happened to be in the middle of a recession, anybody could have handed the keys back to the lender and walked away. No credit report hit, no deficiency judgment, no IRS tax lien, no recourse whatsoever. They just walked away. Now, with regular mortgages, the IRS came a-calling. The bank came a-calling. You owe us $75,000. How are you going to pay us? Oh, we're going to waive it. Okay, well, now the IRS comes a-calling, because when a bank waives the interest, waives the debt, they send you a 1099, and the IRS will take that as income. With this program, there's no recourse. It is the safest loan in America. Any questions? Keep them in the chat. Okay, so when does this loan due? Well, it's when a person is done with the property. They've sold it, they've died, they've moved away, when they're no longer living there. If they change the title, sometimes people will put the title in their kid's name trying to avoid probate. Well, if you do that with any kind of a mortgage, you're changing the title, and the bank's going to call the loan due. You got to pay the taxes, the insurance, the HOI, the homeowner's insurance. You got to pay your homeowner's association, just like any other mortgage. You got to follow the terms of the mortgage contract. A mortgage is a mortgage is a mortgage. The primary difference between this mortgage and a regular mortgage is that you don't have to forward a check to the bank every month. The payments are optional. So who's eligible? Well, you have to be 62 years and old or older for the FHA, 55 for the portfolio. The nice thing about the FHA is the spouse can be of any age. For the portfolio, both borrowers must be 55. So let's say we have a 62-year-old single person, and they have a 42-year-old kid. They're related, but they're not married. Well, we're not doing the loan for the 42-year-old kid. If the 62-year-old was married to a 42-year-old person, that's fine. And the legally married is the answer. So if it's a gay couple and they're legally married, we're fine with that. we can do loans for relatives as long as they're 62 and above. So I've had a 92-year-old mom with a 62-year-old daughter. We can do it because they're both 62 and above. It's the married part that changes the rules. If they're married, the person can be of any age, 18 and above, unless we do the portfolio, and then it's 55 for all borrowers. Interesting enough, we can do it up to 4 people. We can do one loan with 4 people as long as they meet the age requirements. And that actually came into play when we had mom and dad and daughter and what do you call it, son-in-law. So we had the younger people and mom and dad. We had 4 people on a loan one time. And we did it that way because mom and dad was planning on leaving the house to the daughter, and the daughter was living with mom and dad anyway. So let's do it. And it's going to be based on the youngest person's age, of course, but it just makes the probate process, because there is no probate, much easier, the transfer of the title. Okay, no credit score required for the FHA version, but credit does matter. Do they have the ability to pay their bills, which means they have income, and do they have the willingness to pay their bills? Some people have the money, they just don't pay their bills. Some people just, I'll pay it when I feel like it. What are they going to do to me? What are they going to do? If I miss a car payment, I'll make 2 next month. Okay, that's the willingness. So they do check on that. And if a person has had some life events, then we take that in consideration. We don't just deny people, not the portfolio and not FHA. They don't really want to deny anybody. What can we do to explain why a person missed a house payment 2 years ago? Citizenship is not required, but they have to have a Social Security number. All right, Don, you keep an eye on the chat?
Yes.
Okay, so the property must be their primary home. No vacation homes, no second homes, no investment properties. It's got to be their primary home. Single family homes all day long. That could be called a townhouse, a villa, a cluster home, a modular home. Single family home is a broad category. New construction is fine. We can start the process before the house is completed, but we can't close until the certificate of occupancy is issued. And we can do up to a quadplex and do the loan on the whole plex, not just a single unit. Condominiums are okay. They're a little bit difficult with FHA because they want FHA wants their buildings approved by them, and they're really hard to get approved nowadays because most of the management companies don't want to deal with it. Portfolio HECMs is where that comes into play all day long. It's just a condo questionnaire. The homes must be move-in ready. I say FHA move-in ready, but they just have to be move-in ready. And I put that sentence in there during the Great Recession because we had a lot of fixer-uppers back then. People let their houses go, and then they would walk out and take the appliances with them. So they have to be move-in ready. The house doesn't have to be in perfect condition, but it can't have defects. Like the garage door's got to work, the front door can't have a crack in it, the windows can't be broken. There's got to be a shower head, the toilets can't be cracked. And those are all true stories, by the way, that has come into play over the years. We can do manufactured homes. Yeah.
One question, then. How long does someone have to own the home before they can do a refinance?
Same day. You could close on the home today, and we could do an application tonight. There's no length of time. Manufactured homes we can do. Proprietary portfolio HECMs don't like manufactured homes, but FHA will take them all day long. They got to be manufactured July 15th or newer, which, think about, that's 50 years ago. They've got to be at least a single wide, and as funny as that is, construction trailers are pretty small. They won't do construction trailers. Ideally not leased land, even though we could do a manufactured home on leased land, but usually the lease is not worded properly, so as a rule, no. But if you come across somebody who wants to move into a manufactured home or even a regular home on leased land, get a copy of the lease and let's read it and see if it meets FHA's requirements. Manufactured homes in a condo, right? Some real estate agents don't realize that a condo is a term of how something is titled. Like co-ops, it's how they're titled. So yes, there's such thing as a land condo. They don't have to be high-rise buildings. And parts of Bay Hill in Orlando, Arnold Palmer is in land condos. There's a co-op in Orlando, north of Orlando, called Zellwood Station. A co-op. Now, those who don't know what co-op is, a co-op is like a corporation with shared owners. There's like a bunch of stock shares. and New York is full of co-ops. But it's a unique way to um, own property where everyone owns a little bit of everyone's property. It's sort of interesting. Okay. So what about the money? The money must be their money. They cannot borrow the money. So where does the money come from? Checking, savings, CDs, IRAs, investments, sale of a recent home, sale of a vacation home, IRAs, 401ks, cash value from life insurance. I had a person sell a vehicle and we had documentation from PayPal. I had a person sold gold bars one time and we could prove that they bought the bars, sold the bars, all serial numbers. Gifts, gifts are allowed even from friends. And I had a gentleman who had a really good friend who gave him $50,000 gift so he could buy a house. Now, if they had a side deal, I don't know anything about that, but we had a gift from a friend. Now, we just had to establish the friendship. And there's all sorts of ways of establishing friendships. A high school yearbook, Facebook friend. There's all sorts of ways of saying, yes, this is my friend. If nothing else, just an affidavit saying, yeah, he's my friend. It's not something that they're that picky on, but it can be a gift from a friend. You cannot borrow money to borrow money. So you cannot even borrow money from yourself. You can't borrow money from your IRA because it creates a payment. You cannot borrow money from a second home to pull out the cash. Now there's an asterisk next to these. So if you do take money from a credit card, if you do take money from a home equity line of credit from a second home, you have to season it. Your clients have to season it in their bank account for 2 months. Now we're going to know about that because it's going to show up on the credit report. But as long as they've seasoned it for 2 months and they can afford that payment on that loan, then we can do it. Cannot do first-time homebuyer programs because indirectly that's a lien against the property because the first-time homebuyer programs come with strings attached. In other words, it's a forgivable grant as long as you live in the house for 15 years. And we'll give you $20,000 towards your down payment, right? FHA wants to be in first lien position and second lien position. HUD, the lender is first lien. HUD wants to be in second lien position in case the lender were to fail. They want to be able to protect everyone involved in the loan. So they want to be in second lien position. And even though it's technically a ghost lien, it's a zero balance kind of a lien, they want to be there because it's a non-recourse loan. Any questions?
Yes.
Yes.
Pamela mentioned regarding that situation with the $600,000 and 25% down, that they would run out of money. And I don't think that's going to happen, but that's all she said. They will run out of money, and that's not true, based as you explained.
Well, yes and no. I hear that question a lot. It's a really, really good question. So remember, the contract for this loan is lifetime. And nothing in the contract says, well, as long as you have money left over in your line of credit, the loan is still valid. No, it's not like that. It's a lifetime loan. If you, at the time of closing, take every dollar that you can possibly take and you run to Vegas and you lose it all, you come back the very next day and you have nothing to show for yourself. And I'm exaggerating, but I'm just answering your question in a very extreme way. So you borrowed every dollar you can using your HECM loan, and the very next day you spent it all. And you spent every dime of it. You have nothing to show for it. Now, you're still surviving because you have Social Security, maybe a pension. You know, you're still surviving, but there's no money left in the HECM. The line of credit is empty. The loan is not affected. It's a lifetime loan. Live in the house the rest of your life. 30 more days, 30 more years, 50 years, 55 years. The loan is not affected. There's no more money, so obviously it affects you financially, but the loan is not affected. It's a lifetime loan. There's no required payments. It's a lifetime loan. If that didn't answer your question, ask me another question. Okay. Out-of-pocket costs. So other than the down payment, which includes the closing costs, as we mentioned earlier, the appraisal is going to cost, currently it's about $575. But when I typed this up years ago, appraisals were 6.25. I don't know how they come down because nothing comes down in cost, but they're 575 right now. So they're going to pay, in addition to the down payment, they're going to come up with $600 for the appraisal. If they want a home inspection, they'll pay for that also. HUD counseling, because these are federal government, the FHA is a federal government loan, guaranteed loan, and the proprietary follow federal guidelines, so they all require counseling. It's a 30-minute phone session. They get a housing counselor on the phone. They discuss the good, the bad, the ugly, answer any questions. It takes 30 minutes. Usually, if they need to be on the phone for 60 minutes, the counselor's job is to be a neutral third party. And then they get a certificate of counseling. So your typical loan costs, doc stamps, intangible tax, recording fees, title searches, land surveys, all that stuff that you all are all aware of are part of the third party fees. You have the FHA fee. If we do the FHA loan, the FHA charges a 2% fee. Now, here's some ugliness about this loan. Some people say if you do this kind of a loan, it's very expensive. Well, they're talking about this 2%. So if your client buys a $500,000 house, FHA is going to charge $10,000, 2% of the purchase price. Now, portfolio HECMs don't do that. It's built into the interest rate, but FHA has everything on a line item. So $10,000 is $10,000 more than traditional financing closing costs. Yes, it's an expensive loan, but then again, there's no required monthly mortgage payments. Is it an expensive loan? I would say no, because cash and cash flow is the most important thing in retirement. And not having a mortgage payment, it makes it a very cheap loan. Plus, the interest rate is typically less than regular financing. So you're saving a quarter point, half a point over regular financing. That makes it a cheaper loan. Then there's an origination fee. Now, in some circles, it's called points. In our world, it's called origination fee. Points origination fee. But for the FHA version, FHA caps the origination fee at $6,000. Now, it's done based on the purchase price of the home. So a $300,000 home, the origination fee might be $4,000, $5,000. On a $500,000 home, it's $6,000. On $1 million home, it's $6,000 because FHA caps it at $6,000. So the origination fee is points. The purpose of the points is it's a line item, right? That's how FHA requires us to do things in our world. But it also buys down the interest rate a little bit because the lower the interest rate, the more we can loan. So it's always about loaning as much as possible so there's less down payment for your client. It also pays for processing, underwriting, and it goes towards the commission of the loan officer. So there's a purpose of that. So think about this. If somebody's buying a $500,000 home, now remember the down payment is already calculating the closing costs. So we're not asking for more money. But part of that down payment is going to be, for a $500,000 home, is going to be $10,000 for FHA, $6,000 in origination fee. Now we're at $16,000, and probably another $6,000 in third-party closing costs. So closing costs are probably going to be around $22,000 to $24,000 to close this loan. And some people say, whoa, that's a lot of money. I can get a regular mortgage with a closing cost or maybe $10,000 or $12,000. Well, that's true. Closing costs are perhaps double in this example I just gave, but there's no mortgage payment. And it's already part of the down payment that we've been discussing all along. So very rarely in my 26 years of doing this loan, very rarely do the third party fees, the closing costs, ever come into a negative kind of a situation. Yes, people say, whoa, that's a lot, but it has never killed a deal. Never killed a deal. Because when they look at the bigger picture, it just makes too much sense. All right, any questions?
Yes. Question is about a woman who's in her 90s looking to take out a loan with no payment, no money down, no down payment.
No, that's I'm sorry, Miss I'm sorry, no, when my mother-in-law got a HECM loan in the 90s, when in 1990s,
Oh, okay.
okay,
I'm sorry.
she had no money. I mean, we needed to find something so she'd have something to live on. So the loan was one in which, all closing costs, everything was taken. There was no down payment on that particular loan. And of course, the house went back to the bank. That was fine. There were no payments. She got money out. It was fine. Is there any program like that left, currently?
Yes, yes. So
Okay.
that's a refinance. Your mom-in-law already owned a house, right?
Yeah, owned it. It's not a
Yeah.
refi. It
Well,
was, they used it, they actually at the time, they called it a reverse mortgage, what they called it.
right. There's the reverse mortgage is the type of loan, a VA loan, an
Right,
FHA
right.
loan, a conventional loan. So
Understand.
reverse mortgage, HECM, is the type of loan. She already owned the house. So she has two choices. She can either purchase the home using a HECM for home purchase, or she can, if she already owns it like she did, then it's a HECM, it's a reverse mortgage, but it's called a refinance because she already owns the house. She's not buying it, so she's doing a refinance into a HECM reverse mortgage. So in her case, potentially she would have to pay for the counseling. Now, there's ways around that, but to keep it simple, she'd pay for the counseling, 150 bucks, and she'd pay for an appraisal. Now, some lenders will pay for the appraisal on their behalf if they don't have any money. So potentially she had no money out of her pocket because it's possible. And then all the closing costs are rolled into the loan. So she borrows X number of dollars at closing, and then her initial loan balance will be what she borrowed plus the closing cost. So in your mother's in law's case, that was perfect for her because she was able to get into this program with basically nothing out of her pocket, and she was able to stay in this house for the rest of her life and have a better financial life because
So that
her
program is still there. That's all I really wanted to make
yeah,
sure.
and
Okay,
this is what
good.
we're talking about today. This program's been around since 1988, 1989. It's the same program, but probably new and improved over the years. Same program.
But
Yep.
Tim, the other answer is, I think to the question is the home, and what you say, Pamela, is that the home went to the bank. And this is in a reverse mortgage, in a refinance program, the home does not go to the bank. The home would go to the heirs initially. And the
Well, yeah,
heirs can
there's
be
too much of a mortgage by the time you're done with the cost, and there was no money down. So it was, as the years
So,
passed and the interest rates raised and no mortgage payment done, remember, there's no money in this, then, and it was a percentage of the appraisal that when she initiated the mortgage. So by the time she was, that she had passed, it was worth, you'd have to pay the bank probably equal or more than what the property actually was worth. So it just went back to the lender.
so let's talk about that. We're up to 30 minutes away from the end of this 2 hours, so we have time. So let's talk about that. Because it could happen. It could happen even under today's
Yeah.
lending requirements. But in the 90s, FHA was way too generous on these loans. Depending on your mom-in-law's age, they could have loaned her as much as 80% of the value at that time. Now,
About 70. Yeah.
over the years, FHA has come to realize they cannot be that generous because we don't know for a fact that the homes grow in value. Sometimes they go down in value. Right now in the state of Florida, homes are coming down in value, right? The last 5 years they've been going up, more than that even. But they're going down right now. So we
Mhm.
don't know what the house will be worth in the future. And during the housing recession, it freaked FHA out because there's a trust fund. FHA, this is not this is not a taxpayer-based program. This is a self-sustaining program that FHA created in 1987, and it has always maintained itself. It's self-funded. So what they do with all this money that FHA gets, this 2% of the appraised value, they put it into a trust fund, and then the trust fund is used to pay claims. It is backed by taxpayers ultimately, but it's never in 35 years, almost 40 years, ever been a taxpayer-based program. So this trust fund back during the housing recession had hundreds of billions of dollars, just gobs and gobs of money, because claims were almost never paid. And during the housing recession, it dropped way down to the point that they were actually talking about asking taxpayers to bail FHA out because we were all in trouble back during the housing recession. Didn't happen, fortunately, so we don't have that black eye. But they cut the amount that FHA cut the amount that they're willing to lend now. So now they're only willing to lend 40 to 35 to 45% of the home's value. Where back then, if somebody was 85 years old, they might loan them 80%. 80%. And so to your point, what probably happened is they loaned your mom-in-law a lot of money. Interest rates were probably 7%. I don't know, maybe even higher than that. And she made no payments. And the house probably didn't increase in value from the time she did the loan to when she was done with it. It was probably the perfect storm. The good news is, A, the family's not upset. I can tell you're not upset about it. That's good. Mom-in-law lived a better life financially. The kids are happy that mom had a better financial life. And what do you do with one house and 4 kids or 2 kids? You sell it. And when you divide anything in half, there's nothing left, right? You divide anything up, there's not a lot left. So the most important person on the planet was mom-in-law, right? And she had a better life. And if there was nothing left for the family, well, it is what it is because it wasn't your money anyways. So I think you agree with that. I think I do. All right, let's talk about this now. We're going to skip over this really fast because this is not necessarily a financial planning um, class, but I want people to understand that when a HECM is used properly, it'll actually increase a person's net worth. For an example, under current law, if you're 62 years old and you're still working, like most of us are, even if you're doing it for fun, there's only so much money you can make in any given year before the IRS comes a calling. And when they come a calling, and I think that number is like 25,000, but if you make more than that, then they want 50%. The tax is 50% of your excess earnings. They take your Social Security check away from you. 50% of it, anyways. Taxable situation. If you delay Social Security, then every year you get an 8% pay raise on your Social Security. In other words, if you wait till 63 to draw Social Security, you get an 8% raise, approximately 8% raise. So if you don't have to draw Social Security at 62 and you can wait to 65 or 67, you might want to consider that. Now, I'm not a financial planner, and I'm not even sure if I'm going to wait to 67. I'm 60 right now. I might draw Social Security at 62. It just depends on the tax laws at the time. But I'm not sure what I'm going to do. But the point is, I'm not giving advice because I'm not even sure what I'm going to do. But if you want to delay Social Security, but you need the money, getting a HECM at 62 and living off of the tax-free proceeds of the HECM in order to delay Social Security might be a good idea because you're not going to pay taxes on Social Security. You're getting an 8% pay raise every year by delaying Social Security. You're not paying taxes on money that you're getting from your HECM. It might make a ton of financial sense. Something to think about. Financial planners love the HECM when they realize that it keeps their portfolio intact, right? You don't have to withdraw money from your IRA. You can let it compound tax deferred. Delaying taking money from investments, CFPs like that, plus it helps your future portfolio. And it's always about the money in retirement. So what's next? So once you've identified a home buying senior, and don't be afraid to ask somebody what their age is, because we age discriminate. We can't do a loan for somebody that's not of age. You have to ask them. And if you're not comfortable asking them, you can just say, are you over 62? Because if you are, we have a special loan program for you. So don't be afraid to ask. But once you've identified a home buying senior, contact your favorite loan officer, your HECM specialist. Not any loan officer. You got to find somebody like us that know what the heck we're doing. And one of the first things we're going to do is verify their income, their credit, their assets. We're going to give them a pre-approval letter, and we're going to give them a list of FHA counseling agencies for them to call to get the counseling knocked out. When you go retirement home shopping, you don't need to tell the seller's agent or the seller that you're doing a reverse mortgage because you'll probably freak them out. If you do, then make sure they call us to get the good, the bad, and the ugly, because it's not going to take any longer to close this loan than any other mortgage. It's probably going to be easier to get them qualified, and they're probably going to be able to sell the house at what they want to sell it for. So I don't want anybody to be afraid of this program because it's just a mortgage. And if they do the FHA HECM, then it's just an FHA loan. So do the sales contract the way you would normally do a sales contract. Under the box where it says the type of financing, check off FHA. This is an FHA loan. If we do the FHA HECM, and most loans are, check off the FHA box. Don't even put in HECM. Don't even put in reverse mortgage because all that's going to do is freak people out. It's an FHA loan. Down payment, 65%, finance 35%. Or if you want the exact numbers, the loan officer can tell you this much down and this much we're going to finance. It's going to look good on paper. Home inspections are not required by us, but home inspections I feel are pretty important. So there at least has to have the contingency for that. If we're doing the FHA version, there's a mandatory clause on a real estate certification. You probably have that in your office, but if not, we can give you our version of it. Seller concessions are allowed up to 6% of the purchase price. So just like regular mortgages, regular sales, you're going to fill out the sales contract the way you would normally fill it out. Now, the nice thing about our program is we don't have TRID. We still use the HUD-1. We don't have a settlement disclosure. We're old school. We do everything. Well, we can do the application electronically, but we do the closing with an ink pen. It's just the way FHA is. If there's any mistakes, this is our best friend, right? Don't be afraid of making a mistake because we will just do an addendum. No worries. So again, the loan officer is going to verify the client's income, the credit, assets, whatever we need to get this thing done. Now look, halfway down this page, this is pretty cool. So the income that they have must cover their expenses, but the debt to income ratio that we have for a married couple, they only have to have $886 left over in order to qualify for this loan. So for an example, let's say that their income is $10,000 a month and property taxes, homeowners insurance, HOA dues, and everything that shows up on their credit report, car payments, credit card payments. If they had $9,000 worth of monthly expenses, they would not qualify for any kind of financing on the planet, right? No loan, no bank's going to give them a loan except this. As long as they have $886 left over to buy groceries, pay for their cell phone bill, life insurance, health insurance, whatever they want to buy that doesn't show up on a credit report, then they qualify. If they're single, it's $529 a month. Now, I've met lots of people that don't have that kind of money. They don't qualify unless they have a bunch of money in the bank, like that they're not using to buy the house. I have met people that have no income. They have not drawn Social Security yet. They're 62. They have not drawn Social Security yet. They don't have a pension yet. They've retired. They have no income whatsoever, but they got $500,000 in the bank. All right, we can pretend that's income and qualify them. So there's always ways. There's always ways of doing things. Now, they cannot be delinquent, keyword delinquent, on federal debt, whether it be a student loan, an FHA loan, a VA loan that they've defaulted on. They cannot be delinquent. Now, if they owe the IRS money and they're on a payment plan, that's fine. If they have student loans and they're on a payment plan, that's fine. If they defaulted on a FHA loan within the last 3 years, if it's defaulted, we can't do this. If they're on some kind of a payment plan, that's fine. We're good. And we are going to verify income. We are going to pull their credit report. But it's whether it be the portfolio or the FHA, they're relatively easy to qualify for. They just have to have the down payment money. All right, questions? Okay, so here's what's interesting. FHA will do a loan, the FHA HECM, up to a $1.249 million property. Now, that's a little bit inaccurate because you can certainly do an FHA HECM on a 1.5, a $2 million property. But FHA is only going to consider the home to be worth $1.2 million when they do the calculation for what the down payment's going to be. So remember, we're going to make available, there's a 50% boost in purchasing power, but I'm going to go back to the 65%. So I'm going to pull up my calculator here, and let's say that you're able to sell a $1.25 million property. All right, we're going to keep it simple and not use that 49. And let's say the down payment is 65%. That comes out to $812,000. So you have a client with $812,000, and they're buying a $1.249 million house. We're gold. But what if the home that you're selling is $1.5 million? All right, so $812,000 is their down payment, plus the difference between the 1.5 and the 1.25. So plus 250,000. So their down payment in this example is $1,062,000. For $1,062,000, they're buying a $1.5 million home. Now think about that. You think rich people that can afford a $1.5 million home, you think they have cash? They might, but they don't want to use it. They don't want to use it because they have gotten wealthy by using other people's money. They don't want to use their portfolio. It's probably in investments making money. They want to leverage, but they don't want a mortgage payment. So you're able to sell a $1.5 million home for $1 million down, and you'll do that all day long. Now, at the same time, they might be interested in the portfolio reverse mortgage. The portfolio HECM will use the entire value of the property and determine what the down payment's going to be. So on a portfolio HECM, a $1.5 million property, the down payment, the interest rate would be higher, but it might be worth it to them. Let's say we do the same 65%. The down payment is $975,000. That's almost $100,000 difference of a down payment. They might be more interested in having a little higher interest rate, but less of a down payment. For $975,000 down, they can buy a $1.5 million house. And your commission is based on what? The sales price of the house, $1.5 million. Would you rather sell a $1.5 million house or a $1 million house, right? That's a 50% higher commission rate for you. This program is going to increase your income next year, starting in 2026. If you only did one of these loans a year, your income is going up. 2 loans a year, your income is going up. And remember, you're not selling loans, you're selling houses. We're here to help you. Now, here's some interesting statistics. There's 13,000 people turning 62 every single day in the United States. Every single day, we have 13,000 more potential customers. I like to say they all moved to Florida, but we know that's not true. Up until recently, 1,000 people every single day of all ages were moving to Florida. The numbers come down a little bit in 2026, but 1,000 people moving to Florida, and people are moving to Florida in groves, even in 2026. But 24% of people they're already living in the state of Florida. 24% of the people that live in Florida are already 62 and above. That's 1 out of 4 people that are your potential customers, our potential customers. According to NAR, 35% of every home sold in the state of Florida in 2025, 35% were sold to people 62 and above. 1 out of 3 of your customers are already 62 and above. As long as they have a substantial down payment, they're eligible for a HECM, most likely anyways. 77% of the nation's wealth, cash buyers, is controlled by senior citizens. I've had real estate agents say, well, all my customers pay cash. I don't need this program. Oh, all my customers pay cash too, except they buy a nicer house. All your customers pay cash. They just get a nicer house, and your commission's higher. 86% of seniors want to age in their own home. Not everyone can age in their own home. Maybe they're too far from their family. Maybe they live in a 2-story house. Maybe they live in a house with stairs. Maybe they need to move. And as a real estate agent, you can help them move by selling their existing property and helping them buy their right home. we like to use the word downsize, but it could be more like right size. We can right size their retirement home so they can age in place. And 96%, as I mentioned before, of the people who have ever completed a HECM, of the people in the survey anyways that AARP did, are satisfied with their HECM. If you are not working the senior market, then you're missing a lot of opportunities for sales. I would challenge you to go one step further if you're not already doing this, but actually focus on selling homes to seniors. Focus on age 55 communities. Focus on areas that are established where more senior citizens live. Help them list their house and buy a newer property, maybe a brand new home. Help them move closer to their family. Work the senior citizen population and you will have more sales. And the fact that you're here answers the very last question in red. Are you keeping up with these changes? 97% of real estate agents don't know about the HECM for home purchase, but everyone on this call now has. And if you've heard about it before, now you understand how this program works in a way that no other real estate agent understands. You will make more sales because of your knowledge today. Now, this is one thing you can put on your MLL listing, and it meets compliance. In red, just one large down payment and no monthly mortgage payment for life. You can put that anywhere you want to because we're not talking about interest rate, we're not talking about age, we're just talking about one large down payment. We're not giving percentages of down payment. And what's going to happen is a 35-year-old is going to call you and say, "What do you mean one large down payment and I have no monthly mortgage payments?" Well, sorry, you're underage. You don't qualify for this particular program, but you could still buy a house. Let me put you in contact with a loan officer that can get you pre-qualified. And maybe we can get you 3.5% down or 20% down and get you financed, right? You don't care what their age are. You just want to sell a home. You want to be different than your competition, though. You want to advertise things that will help your phone to ring and get more listings and make more sales. And the HECM for home purchase will help you do that. You know, I'm a big fan of HECMs. I've been doing this for 26 years. That's the third time I've said that. This is what I personally specialize in. This is what Don Mulcahy personally specializes in. And my company is licensed where we can sell anything. We can sell VA loans, USDA, whatever. But we specialize. The name of the lending company that I get paid by, this is the HECM Association, which is a 501c3 nonprofit real estate school. But where I hang my hat is HECM. That's the name of the company. HECM Senior Home Financing. HECM is what we sell. Senior. We sell homes. HECM Senior Home Financing. So always do what's right by your customer. If they're a veteran, maybe the VA loan program is right for them. Nothing down. A few closing costs, but nothing down. FHA, 3.5% down. Conventional mortgages, 5% down, 20% down. Jumbo loans, $5, $6, $7, $10 million loans. By the way, the portfolio HECMs, they don't really have an upper limit. If you have somebody who wants to buy a $20 million home, FHA may not be the right for them, but the conventional, the proprietary loan might be, because we can do HECMs on a $20 million property. First-time home buyers, if you're not certified, you might want to look into that because that opens up doors. USDA for rural properties, and of course, cash. This is one of my favorite slides. By the way, we are minutes away from being done, no more than 10, because we will finish on time, if not early. I got a couple of great stories, but I'm not going to bore you with them because they're not boring. So maybe I should. In any case, legacy is important, but a legacy doesn't have to be what you inherit, what your family leaves you. Legacy could be and should be what your parents and relatives does for you or for their beneficiaries while they're alive. Help their grandkids through college. Help their kids buy a house. Give them. I had a lady who gave each of her 3 daughters $5,000 for Christmas. Never done that in her life. But she did a HECM, had all this extra money, didn't need the money. In fact, she complained that she was getting too much money. I kid you not. She was complaining. Her house came in more than we expected, and she got $60,000 more in her line of credit than she was expecting. And she just, I don't want it. I don't want it. I said, if you don't borrow it, it costs you nothing. So don't borrow it. And I don't want it. I don't even want it. I don't want to see it. I don't want to see it. Don't want to see it. Take it back. And I said, well, I guess you can, once we close, you can send the $60,000 back, but then it's gone forever because they're gonna pay down the balance. It was a fixed rate at the time, so they're closed loans. And no, I take it back. It was an adjustable rate. But anyways, so it was getting close to Christmas. So I asked her about maybe just writing a check out to her three kids, and I said 20,000 each. Was she didn't? She gave them 5,000 each. But she said it was the best Christmas ever, and that's pretty cool. That's a legacy. Best Christmas ever. Gave them each $5,000. The lady was 89 years old. That means her kids were 65, right? Approximately. The kids are not kids. They're adults. In fact, they probably have grandkids too. But giving them $5,000, even if they didn't need the money, even if they were successful, giving them $5,000 unexpectedly during Christmas is is awesome. Anyway, so build the legacy. You never know about the future. Long-term care is in our future. Healthcare is definitely in our future. It is just part of life. Broken down cars are in our future. The average car today is more than $40,000. I was watching The Price is Right, a rerun on YouTube a couple days ago. 1974 Super Beetle, $2,400 for a brand new Volkswagen Beetle. $2,467 for a brand new Volkswagen Beetle. Oh, those were the days. Definitely pay off debt. Interest rate on credit cards upwards of 30% now. Remodel your home. We all want that. I had a boyfriend, girlfriend that were dating, had their own houses. They did their own HECM with the idea that they lived apart, but they wanted to go on a cruise. Not just any cruise, but a 120-day round the world cruise. They each paid for their own portion and went on a cruise because they got extra money from their HECM. Money that was their money, that they pulled from the equity of their house without having to make a monthly mortgage payment because that's what they wanted to do. Don't waste money because you never know how much you're going to need in the future. But if it fits in your budget, I say take a vacation. So just to sort of hit home how this works, if you have a client that has $5 million for a down payment, you can sell them a $5 million house and have a closing next week. Or you can sell them a $7.5 million house that's on the water with a nice boat ramp that's 5,000 square feet, that has all the luxuries with great neighbors, maybe movie star neighbors, and make a higher commission. It's a beautiful thing. And what happens when you take somebody to a $5 million neighborhood? The house they really want is the $7.5 million house, right? You take somebody to a $300,000 neighborhood, the house they really want is $450,000. Am I right? We always want more than the house that we think we want, because the $300,000 house, chances are, needs some upgrades. You know, someone probably got it, flipped it, threw some paint on the wall, and they move in and they want some upgrades. So why not help them buy a house that they really like, make more commission and make them happier. The good news is on this, we're done. The good news is on this is that we can do this for your office. Now we're doing it for the real estate board, but we can do this in person or via Zoom to your fellow agents. The rising tide, the high tide rises all boats. When more people in your office understand this program, you start working together and start sharing ideas, and the high tide rises all boats. So consider doing that. There is Don's contact information. That's how you spell his last name. Phone number, right to his cell phone, his email address.